It's not about timing the market, it's time in the market. There are things that one can control and there are things that one cannot control. I can't control the wage growth. I can't control the median price increase. So rather than sort of being too stressed, the mindset is, what can I control? How do I still find a solution in between where it is?
If you were to redo it again, what sort of blend would you be looking at?
What I'm doing it right now, after about 26 years of investment, I probably would have brought it back a lot earlier. That is commercial construction. I've done a number of residential construction and I look back and I say, you know what, commercial constructions are easier. Buy as many properties I can, as early as I can, and hold on to it forever.
Hello everyone, welcome to another episode of the Investing for Doctor podcast. We have our accounting extraordinaire, Mr. Munzurul Khan, with us again today.
Thank you. Thank you, B.
For this episode, it's going to be a bit different from our other episodes because It's about to get a bit personal.
Okay.
Right.
Sure.
So we've agreed to talk a bit about your investment journey and with a focus on property.
Sure.
I'm sure, you know, if you looked at one of our very first episodes, you gave a bit of background about yourself. So for those who haven't seen that episode, maybe give us a bit of a recap about your sort of very early days, you know, sort of after you started getting work and how you got started with property.
Yeah, no, absolutely. And I'm being an accountant for many years now, and 30 odd years that I've been an accountant. I started with a couple of a small practice, and then I was at BDO for about 6.5 years, and then I was at PwC for about 4.5 years. Started this whole practice, the KHI and KHI Partners, around 16 years ago. Now, in terms of the property investment side of it, is my investment journey started back in 1999. Now, young, sort of mid-20s, and sort of came in from my father. My father says that, well, you've got a bit of savings, so let's utilize those savings to buy your first property.
That's right before the Olympics, wasn't it?
Yeah, 1999, right? And I was like, oh, no. Why would I buy property? Property prices, you know, why would I buy property? Because tenant dollars sort of ruins everything. You've got this carpet issue and tiles issue and all the rest of it. It sounds hassle. So my father says, so what are you buying? I was like, well, shares. Shares are exciting, right? They're all exciting. Can you see it? You can get up in the morning. It changes every time. It's pulsating, right? I want to buy my shares. And my father says, buy property. I was like, no shares. My father says, listen to me first. Buy one property. Once you buy this property, then you do whatever you
want. Yeah.
I was like, okay, I'm going to buy this property, right? Yeah. So I had about $24,000 is all I had. And I remember that we bought this property, tiny little property in Ingleburn, nothing fancy at all, for about 120 odd thousand.
For those that don't know the geography, where is Ingleburn?
Ingleburn is in New South Wales. It's a very suburban Campbelltown, southwest.
Southwest, yeah.
Bit of a low socio-economic sort of an environment, nothing fancy. The most basic of the basics, sort of a 3-bedroom, doesn't have a garage, it's a bit of a carport, and the house by itself is only about 350 odd square meter. In those areas, it's pretty small. So I bought this very first property, right? And I bought that for 120 odd grand. And the rent at that stage was, believe it or not, was 180. So it was about 7 to 8% return that we used to get on those days. That was the property I bought. And then I went back to my father. I was like, oh, I shouldn't have listened to you. Why did I buy this? Look at this. This happens, that happens, right?
And you started off reinvesting, I guess.
It was reinvesting. That's right. Because I was living with my parents. That's right.
So you invested the first property.
That's right. Because exactly. I was living with the parents, right? And I was like, oh,
free rent.
What did I do? This free rent.
That's the best kind.
And free food.
Yeah.
So, you know, it's sort of, and I was sort of whinge and complain, right? After about 4, 5, 6 months is that I stopped whinging. And then one day my father sort of picked up saying, how's your property going? I was like, it's okay. And I was like, what does it mean? How is it okay mean? So I was like, yeah, it's done okay. And I was like, okay, so tell me, what does okay mean, right? So, you know, within that 6 months, I was probably fortunate at the point of time that it was sort of being bought. I bought it for 120 and the price has sort of gone up to about 150 or so within that 6 months. And I remember I was sitting down, I was doing my maths. I was like, how does it work? Because even though I bought it for 120, it's gone up to about 30 odd grand. So it's gone up to 25%. Is it really 25%? Because my cash contribution was 25%. So I hardly had about 24 grand or a bit higher or lower at that stage in terms of cash contribution, right? So if I take 30 grand increase on my initial cash contribution of 24 grand is that I've got
More than doubled your
100% gain. And it's not 100% gain because it was over a period of 6 months.
Yeah.
So it was even better, right? And how do you beat that with the share markets or anything else, right? I mean, there is some exception to it, I understand, and sometimes things happen. So this sort of started me thinking. And before I knew, I had my second property, third property, fourth property. All of those things happened randomly. There was a whole bunch of different random reasons why those properties happen. You know, my second property actually happened because we got married. Purvi and I, we got married. And it's not a good story, but Purvi and I, we got married, and I had about 25 grand credit card loans at that stage. And I remember I came back from Bangladesh, and this is back in 2000, 2001. And that 25 grand as a credit card loan was a big loan. My annual salary was only about 36,000. And I was like, how am I going to pay this off ever? So I took counseling from a mortgage broker, and mortgage broker says, look, what he can do is that he can buy another property, and I can amalgamate that loan into your home loan rather than a 5 years loan, or short term, it becomes a 25 years, repayment drops. And I was like, wow, that's genius.
Wow. Yeah.
That's genius, right? So I actually bought the second property to pay off the credit card.
Now that you mentioned that, what was the sort of lending standards or requirements like back then? And what was and if you remember, what was the interest rate back then?
But what's so funny, right? Because we sort of say interest rate is so high and all the rest of it, right? My interest rate at that stage was 5.99%.
Yeah.
So it's not much different than what we have at the moment, right? So that was the interest rate what we have. What was the lending criteria? Similar to what we had. The rents were a little bit higher, right? It was 7 to 8% return was sort of more common, but bank were a little bit more restrictive. There was not as much of the sort of creativity that we have at the moment, right? It was more sort of that you follow it, it works, you don't follow it, and it doesn't work, right? So that's where, and then once I had that 4 property, that was the first time that I sat down, I did a plan. I sort of say that, okay, I've got about 4 properties, 5 properties now, I'm been investing about 5 years. What do I really wish to do in the longer period of time? And that's where I sort of sat down. I did a bit of a strategy and plan, saying that, well, I want to go a bit deeper into the property investment. I want to buy this, I want to buy this, I want to buy this. And I look back and I say that was probably one of the best thing in many ways that happened in my life on financially of doing that bit of the plan. Because what that does is that it strengthens your mind, it stretches your mind, and at the same time, it sort of quantifies and narrows down of your focus of the objective.
I see. And so obviously you continue that plan, I would assume.
Yeah, and it's a journey, right? And I sort of look back now and I say that we've been very, very blessed. We've got a whole bunch of properties in Sydney, Brisbane, Melbourne, Western Australia. We've got residential, we've got commercial property. We do a bit of a construction here and there. And now I'm going quite a bit in commercial construction. And this is the first time I'm sort of doing commercial construction. I've done a whole bunch of residential construction. So I bought a whole bunch of properties, right? And as an exception, at a point of time, I bought very regional property. But generally speaking, my investments are more sort of the suburban property. Nothing too fancy, sort of pretty standard, sort of a mom and dad properties, as I call them. But when you work in terms of compounding impact, and when you work in terms of scaling over a period of time, those whole bunch of very ordinary becomes very
the middle growth
extraordinary.
area.
And it becomes very extraordinary purely because it's not because they're a whole bunch of ordinary, it's the quantum and it's the time, i.e. the scale and the compounding impact. It makes it really work.
Yeah. So, I mean, you said it's very suburbia, very, mom and dad. So you never really focus on the high end sort of property, nor the too low end property.
That's right.
Yeah.
There's this author, lady named Jan Somers. Now, Jan Somers is being known by some of the really sort of the older investors as such. She only wrote 2 books. And she was being known as the initial pioneer. And she wrote 2 books, one of them called More Wealth, and the second book is 101 Stories. And Jan Somers was one of those earliest sort of person who sort of says, I reached into my retirement through the property investment, and she genuinely did. So I was in one of these seminar of Jan Somers probably about 20 years ago now. And Jan Somers says that, what is the secret? And Jan says, then Jan was going through in terms of a whole lot of the article of going back into, say, 80s and 70s and 60s and 50s newspaper articles. And she was showing it over and over how the articles repeats more or less the same message. Property prices are too expensive. Our next generation would never be able to buy any of the properties. We are so much dearer than any other OECD countries. It makes no sense in terms of our combined income, the family income, and the multiplier of the income that we need to buy our houses. So our next generation are all broke. We've been saying the same thing since mid-50s and 60s.
Yeah.
And what Jan says is that property investment is never easy. It's a big investment. You need lots of things in there, but success comes in who has the ability to solve a problem. That's where the success comes in. And for one to solve it, Jan says that you have your own plan. My plan as a Jan Summers is very simple. This is Jan's, buy as many properties I can, as early as I can, and hold on to it forever. And by doing it this way, say as many properties as I can buy means that I'm giving that a scaling and compounding and the time. As long as I can, right, buy as many properties as I can and hold on to it as long as I can. And where it is, by doing it this way, you get that sort of your perpetuity, you get your compounding, you get your scaling, and hold on to it forever. Because Jan says, if it's a really good investment, why do you need to sell it? There are ways that you can extract the equity out of it. Every time when you sell it, you've got a selling cost, you've got a CGT, you've got a repurchase cost, right? Now, it doesn't mean you don't sell it. There could be a genuine reason why you sell it, but don't sell it just to realize that profit and say, my paper sort of the profit shows that I've got a 200,000 growth. I want to sell it. I want to see that 200,000, right? You don't need to, because you can extract that equity in many different ways. Hold on to it forever.
Yeah, beautiful. That's all those points are valid, obviously.
Yeah.
But how do you, when we look at that those numbers, right?
Yeah.
What we're seeing today is that perhaps yield is going lower and lower and lower. And the prices of property versus the median wages is also getting higher and higher and higher.
Yeah.
And I guess some of that is because there's more sort of, dual income families coming into the situation. So obviously, naturally, that almost doubles the availability of income to purchase a property, because now you have mom and dad both contributing to a property, rather than, dad being the sole breadwinner 50, 60 years ago. We're not going to add a third person into the family.
No.
How does this translate into the future?
Brilliant.
Given that you've been in this journey for over 20 plus years?
Brilliant.
Because a lot of the younger generations feel locked out of the market.
Brilliant. Brilliant question. And we as a human, and we as a younger generation, and the younger generation coming in, everyone is very resourceful. We find a solution. Yes, there are some of the areas which has become tougher. There are some of the areas which has become a lot more open, and whether it sort of averages out. So I go through the example, right?
Yeah.
So see, if we look through in terms of the interest rate side of it, one argues that the interest rate is sort of probably not as different as it was historically, right? We're sitting about 6.5%, maybe a little bit lower, maybe a little bit higher based on what you do in the residential, right? Have we seen interest rate much lower than that? Of course we did. Have we seen interest rate much higher? So one argues that it's probably not that bad, right? Then the trick behind it comes in is exactly as he said. It's not so much the interest rate, it's the size of the mortgage. I was in this Macquarie Bank, the economic presentation the other day, and Macquarie was sort of showing a statistics into sort of mid-80s and 90s, mid-80s and late 80s, when the interest rate was 13%, 17%, 18%. Even I haven't seen this, right? Because my first investment 1999 onwards, so I haven't seen that sort of mid-80s, right? So Macquarie was going through saying that, well, it was tough at that stage when he got 17, 19. But what they were arguing is that just before we had this interest rate first cut, right, is that they were arguing that the hard money, so to speak, at the moment is almost as bad as he was in sort of mid-80s and late 80s, even though the interest rate is much lower than what we had at that point of time. Number of reasons. One is that inflation was much higher at that point of time, means that you had everything else as
and wage growth was also
wage
high.
growth was there, right? And most importantly is because our mortgage is 2, 3, 4, 5 times of what we had in, say, 80s, means that we're paying that quantum of the fee. And while there was a growth in terms of the wages, but because the inflation has sort of become modest over a period of time, 2 to 3 is our target, means our wage growth, not exactly directly to inflation, but it still didn't have that extraordinary level of the growth. You know, that old saying on the property market, we said that every 7 to 10 years that prices double. And 7 years double means that you get a 10.4% compounding return, and 10 years double means that you get a 7%, 7.2% compounding return, right? That's what we say generally, right? But do we really have wage growth of 7 to 10% every year? We didn't, right? Some of the private sector may have, some of the special private sector may have a lot higher, right?
Well,
but generally speaking.
Yeah, in New South Wales Health, they're trying to give us 10.5% over 3 years. So that's below inflation.
That's where you get the disparity, right? That's where you get the disparity, and that's where you ask the question that, how do we do it? Is it really, truly becoming impossible? I would not dare suggest that it is, in the sense that, yes, it's become a bit higher because the wages haven't grown as much. The prices is sort of in there, so it has become harder. But where it becomes easier, arguably, is the banking has become a lot more open. There is a lot more creativity on the banking now. There's a lot more funding opportunity, right? Like those 25 years loan to go into 30 years loan, having that 5 years interest only. But it's not so much 5 years interest only. We'll do the assessment on the 5 years interest only, right? You've got a self-sustaining trust as an example. You've got a leasestock loan as an example, right? You've got a special construction loan as an example. There is just so much product in the open world in terms of funding, because one argues that at the end, bank still needs to lend it. If the bank cannot lend it, right, then the service isn't there. So it's always that balance from bank's point of view. They want to lend it, but not to get into trouble. And also balance from our point of view. So I suppose what I've learned in between all of those things, there are things that one can control, and there are things that one cannot control.
Yeah.
I can't control the wage growth. I can't control the median price increase. I can't control 1, 2, 3, 4, 5, 6, 7. Those things I can't control. So rather than sort of being too stressed, the mindset is that, what can I control? How do I still find a solution in between where it is? How do I increase my revenue? How do I find a creative solution? How do I find a resourceful solution? And, the answer is, it can be done. I've got many clients who quite easily has 70, 100 plus properties. And they're not 60s and 70s. Right? Yes, they've been doing it for 10, 15 years. And so it can be done in the right strategy, in the right level.
Yeah, that's very interesting. If I was an absolute cynic, I would say, yes, we've replaced those nicer numbers in the earlier days with creative banking and funding sources. But again, that is trying to squeeze that extra bits.
Yeah.
Right?
Yeah.
And the question is, how much more extra leeway have they got, and how much more can they squeeze before there's nothing left to squeeze, and you're stuck in this end game scenario where no one can afford anything anymore.
And you know what? The beauty of it, love that question.
Yeah.
Because I ask this question for over and over and over to all my investors, to myself. Why does our investment need to be only Australian based? Australia, with such a big country, lucky country, is still a small country. Why does our investment need to be on Australian base, right? Remembering that if you go through the whole demography, right? Before the war, he was a single family income. That was how he was.
Yeah.
Right? Men went into the open world. Some of the men died. Some of the men came back. And while they were in the war, the lady says, well, we can't just stay at home. We need to work. The ladies started to go into the work. The men came back and the lady says, well, this is good. We are in the work. We want to continue that. Men says, well, good, right? One income became two income. So it was a shift in your demography as well as the mindset, so to speak. Then we go into 80s and 90s, right? We had a massive shift at that stage. What was the shift? That whole banking industry, as we have spoken, has become decentralized, right? I remember that all Aussie Home Loan first came in and John Simon had that massive sort of the campaign, and Aussie will save you, right? This was this ad that he used to do. And I still remember that his all sort of a voice, sort of a bit of a nosy sort of a voice, right? Is that we grew up with this, that as an Aussie will save you, right? And he was one of the earlier one who sort of challenged the banking system, saying that why does it need to be four major banks, right? You've got the wizard, you've got a whole bunch of people who came
non-bank
in.
lenders. Yeah.
Non-bank lenders, they came in. The banking world became open. That gave us that level of the creativity. That pushed us up to this level. So your question is, what is next, right?
Yeah, what is there left to push?
And then this is where we look back with some of the economists, and the economist says that, well, productivity and all the rest of it, right? Our productivity needs to increase. Australia's productivity, technology comes in, and that will bring in the GDP, that will bring in our lifestyle growth level. It will do this. We set that aside, right? That's that economic explanation. But if we stay in the property explanation, I genuinely think that over a period of time, your investment would be global investment. So I can give you an example without going through the exact country's name. There are countries, very prominent OECD country, that they have never heard of a residential property where you buy a residential property of anything below 8.5% gross return.
Yeah.
It's just that their mind doesn't work. Anything below 8, you do not buy it.
Yeah.
In Australia, we say rule of thumb of 5% is pretty good, right?
Yeah.
Commercial property on that same country, you do not buy anything below 11 or 13% net.
Yeah.
And in Australia, we say 6.25 is pretty decent, right? In Australia, at the moment, you're only going to get 6.25. That's how it is. And the way when we go to the end game, this is where the new game starts, in my view, where Australia becomes open and we find a way to invest overseas. Now, yes, there are risks, right? You need to know the overseas rule, and there is the hedging, and there is this currency, and the regulation can change. Lots of different things. But that's where it comes back to the old Jan Somers point. As long as we can solve that problem, the world is an oyster and the opportunities are there. Much bigger. And I would dare suggest that when that opens, this is where you would sort of say that, wow, this is, rather than being the end, this is actually the beginning of the next phase.
Yeah, absolutely.
We just didn't know that.
Yeah. No, I've seen some of these overseas sort of opportunities as well, and it's much better than Australia. But the big issue is, how do you get the lending and the credit to do all of that sort of thing, which I don't think Australia has necessarily that.
Perfect. You absolutely nailed it, right? It doesn't at the moment, but it also doesn't mean it would not be over a period of time.
Yeah. So this is what we're going to squeeze, right?
And this is where the squeeze gives us the next, right? And the reason I say I would not, like if you look into the HSBC and you look into Bank of China and some of the sort of banks, that they've got a bit more,
banks,
they're more international bank, ICBC, right?
Our
you look into Japanese
banks.
banks.
At all.
They're not, right? I mean, we've got the Big Four, we've got the Macquarie, we go to US and they were like, oh, never heard of it, right? They're not national. So you would find that those multinational banks will become more and more common. The bank will conduit within themselves as a necessity they need to. Product will come in where their lending would be a lot more open over a period of time, right? It's no different to where it was, say, 30 years ago. There was lending was this level, and now you've got all of this lending being open, but it's being still tied in geographically, and I think we'll break through that barrier. On the same note, we look after lots of buyer agents, and we ask this question all the time with the buyer agents. Why is it only Australia? It is such a small country, for being a big country with a small population, that there is only that much you can take out of it. And if the mind goes into the outside, we just need to solve it, right? Mind goes into the outside, it becomes amazing. This gentleman is Steve McKnight. Many years ago, Steve invested quite a bit. He wrote a book of 100 properties and 200 properties, buying it within a period of time. Brilliant mind. And Steve was as an accountant. So Steve invested quite heavily into US at a point of time.
Oh, yeah.
Quite heavily into US a number of years ago, right? And I'm sure that he's still continuing in different ways, but this was quite public investments. And some of the returns that he was receiving at that point of time, we cannot even comprehend in our wildest of the imagination. But in that world, that was actually common. It was not necessarily he was getting very extraordinary property on that area, but it was extraordinary as a perspective back to Australia.
Compared to Australia. Yeah.
And I think that's the new path, my view.
Oh, that is, it's great to hear that, Munzurul. And I think there's still quite a number of things that need to happen before a typical investor in Australia can access that, because, if you're a high net worth, and that's quite easy to assess, because you can go to any of these non-bank lenders and just say, hey, this is what I need, this is the collateral, and this is the deal. And you can access, returns in the teens in the US, for instance. I've seen that. You hear about all these guys having a whole apartment block of rentals, and they're making north of 10%, and overseas the fixed interest loans are a lot longer than Australia.
Yes.
Yeah.
Yes.
You can get 20, 30 years fixed loan.
Yes. 30, 35 years is not uncommon.
It's not uncommon. And, especially in the US, because they're purchased against their 30-year US Treasury bonds. So you can literally lock that in.
Yeah.
And you can just coast on, 3%.
Yeah. And see, that bit of the creativity, all those examples that you've given, Australia hasn't really grown into that maturity, right? Because we are in Australia, we're proud of Australia, and I'm a proud Australian, right? But as soon as you go into the open world, you sort of look back to Australia and say that, it's still a child. It's an adorable child, but nonetheless, it's still a child compared to, say, UK and compared to, say, US and compared to, say, New Zealand. Like we as a KHI Partners, as an example, is that we're extending ourselves into UK at the moment. We're going a lot deeper in terms of acquisition of the practices in the UK. As soon as I'm going deeper into that UK and we're going to go to New Zealand this year. So this is where you become multinational. And as soon as I'm going to UK and New Zealand, I'm looking into the property opportunity that I can't even comprehend in here. And I think that is our future investor over a period of time. It would take time, one gets it, right? You would start with that institutional level a bit more. It will channel through, someone will break through, someone will come up with a system and process, and be not to underestimate the technology. Right. I mean, that technology gives us that availability is so much deeper. I remember the buyers agencies, say about 15, 16 years ago, is that New South Wales buyers agency, they would only buy in New South Wales. Queensland buyers agency, they would only buy in Queensland. For one to go from New South Wales to buy to Queensland, he was like, oh, how do you do that? We don't know the Queensland. We're the New South Wales, we're the Blues, right? We don't go into the other side, we're Blues, right? And I remember that those buyers agents, when they started to go into the Queensland for the first time, it was like a massive thing, right? But now, of course, everyone buys everywhere. Because it is so readily available. So I think there is always a solution. But the question is that who has the, I suppose, resource and the ability to find that solution? And those are the people who gets most rewarded.
Yeah, beautiful. And I think that's something that as a future investor, people will become a lot more global. Just it's the same way as people talk about investing in overseas stock exchanges. We invest in the US stock exchange. Absolutely. And that's a norm.
Yes.
Right?
Absolutely.
Why not properties overseas as well? I mean, it's harder, but it's not impossible.
But was that norm as much norm as it was, say, 20 years ago and 30 years ago and 40 years ago? It wasn't, right? No. So we as an investor on the shares, and so we grew. And it's the same trend.
Yeah, beautiful. All right. Now, we're going to go back and talk a bit more about your portfolio.
Okay.
All right. So, you started off doing mostly residential.
Yep.
And then you got into commercial. When and how did you get into that?
Yeah, look, I mean, over a period of time, there was many years that I only invested residential. And then I sort of moved into commercial. From memory, it was at least 12, 13, 14 years subsequent to it. Now, if I were to do it a second time, would I wait for 12 or 13 or 14 years? I probably would not, right? It was more sort of, I didn't know as well. Now I sort of look back and I say that both residential and commercial has merit to it, right? So residential, one argues that more for growth. Residential, one argues that you've got a bit more stability of the tenants. People come, people go, but you will always find someone. Commercial property, one argues, is that, well, it's a bit more cash flow. Commercial property, one argues that it's a bit more longer lease, right? Residential, one argues you get a higher level of the banking loan. Commercial property, you need to put in a bit more deposit. Residential property, we sort of say, rather than just having your natural growth, you can do manufacturing growth. You can generate the growth. You can renovate and the property prices increase. You convert the carport into garage, the property price increases. You extend into a third bedroom rather than a two bedroom, it increases, subdivide the land, build a granny flex, many ways. So you can manufacture the growth. Commercial property, traditionally we used to say that, well, the growth of the commercial property is that it's all natural. The rent goes up by 3%, your price goes up by 3%. Rent goes up by 5%, price goes up by 5%. Yes and no. Commercial property now, we're viewing it in a little bit different way. We're saying that, well, why can't you manufacture growth in commercial property? You can manufacture growth in commercial properties in a number of ways. Number one, let's just say you renew the lease and you bring it back to the market value, and it was happened to be very low. That by itself is that while you get a 20% increase in rent, you actually got a 20% growth on the commercial property. That's a tick. Number two is that one can create a mezzanine level as an example. So your floor space is increasing. And by doing it this way, again, you manufacture that growth, right? You build something on the back, you build something on the front, you do a whole lot of things. So one argues that whole manufacturing growth can still be done on a commercial property as such. Then I sort of look back and I say, well, what does that mean? Does that mean that if I were to do it again, would I only do residential? Would I only do commercial? You know what? I would probably do a bit more mixture. And I would start commercial a bit early. I might still start with residential just to build that bit of that safe block, so to speak. And then once I have that safe block, I would not mind bringing in commercial property a lot earlier and almost bend it together and blend it together for that bigger portfolio.
And if you were to redo it again, what sort of blend would you be looking at?
Yeah, good question. Very good question, actually. I think the answer to that depends on each individual risk profile,
for you.
Right? And that's right. And also depends in that, what am I after? Am I after the growth or am I after the cash flow? If I'm after the growth, I get more residential. Cash flow, I get more commercial, right? Am I after that sort of the longer term? It depends on many things. I would probably still, if I were to do it, probably do more on the residential and perhaps a lower percentage on the commercial. And what I would probably do is that if I were to do it second time, is that what I'm doing it right now, after about 26 years of investment, I probably would have brought it back a lot earlier. That is commercial construction. I've done a number of residential construction, and I look back and I say, you know what, commercial constructions are easier than residential.
The building codes are different.
You just build a box, right?
Yeah.
And and your box is your storage or your warehouse, right? You make it nice, you do a bit of painting, and that's it. You don't need separate rooms. You don't need all the rest of it on the separate rooms. You don't need that color combination and all the rest of it. It's actually much easier, the commercial property. And the beauty of that construction side of it, of the commercial property, is that you get a bit of an uplift on that growth in day one. Mind you, not for everyone, right? Construction is not for everyone. You need to have a certain layer of experience.
And a lot of headaches sometimes.
And sometimes a lot of headache, right? You got to get the banking and the funding and all the rest of it. You got to get the right builder. You got to choose the location right. You got to do all of this. So while I'm doing commercial construction now, after 25, 26 years of investment, and if I were to do it again, I probably would have started about 10 years ago.
Yeah.
Right? 10 years ago, just to give a bit more commercial into it.
And do you think this is due to the fact that you didn't have as much knowledge back then?
Absolutely, B. Absolutely. You know, it's so much knowledge at the moment, right? 1999, when I started, right, I didn't know anything about trust. Like, I knew nothing about trust until 2004, 2005. This was the first time I was learning about trust. And I remember that I wrote that book for the first time, a book called Trust Magic, by a gentleman named Del Gum. And this book sort of says, you can do that, you can do that, you can do that on the trust. And this is 2004, right? And I was reading this, I was like, wow, I love it. And then I started reading about this trust structure. So I didn't know this, right? Commercial property, I didn't know this up until a very later stage. I've set up my own self-managed super fund probably about 12 years ago, right? 12, 13 years ago that I set up the super fund. Prior to that, I didn't know much about the super fund, right? And when I set up the super fund, it was the first time I was learning.
And that's incredible because you are an accountant.
Absolutely. And you know, so I didn't know, because the self-managed super fund, if you look through, is that borrowing, that installment warrant, it really is just only for that many years. Prior to that, you could not borrow. Right. And that's why that whole self-managed super fund to borrow under the installment warrant to buy that property, it wasn't there. That concept wasn't there. So my growth came in along the way. While, yes, I was learning along the way, but also the fact that, there was nowhere near to the information that we have at this stage.
Yeah.
Where was my learning? Back in 2004 and 5 and 6 was books.
Yeah.
Nothing else. You buy the books, right?
You had no podcasts. You had no YouTubers telling you this is how you get rich.
Oh, no, right? It was just reading the books. There is no podcast. There's no forum, right?
Yeah.
And then you started having some magazine. And I remember that I used to buy this monthly magazine, right? Money magazine, wealth magazine, your property, your investment, smart property investments, your investment property, all of those magazines. Every month, I used to buy 6 or 7 of those magazines. And I used to love reading those magazines for years and years and years, right? And then you follow that through and you sort of say, at a point of time, the magazine started to become electronic.
Yeah,
right?
obsolete almost.
And I was like, ooh, electronic, right? So it started to become electronic. Forums started to come in. Buyers agencies started to come in. We set up many very prominent buyers agents. And I look back and I say many of those buyers agents we set up in 2008, 2009 and subsequent. That means prior to that, they didn't exist. Many of those buyers agencies. If you look through the whole buyers agency industry, right? I mean, Rich is with yourself on the IFD. Rich, one of the older established buyers agents, one of the beginning buyers agents. I think literally when Rich started the buyers agents, Rich can tell better, but there's probably just about 3 buyers agents was there at that point of time. And that's it. That's all we had in the whole Australia-wide.
Yeah.
Right? The whole industry started around that 2008, 9, 10 onward, right? So information becomes so much readily available as opposed to at that point of time. So the question is, what does that mean from an investor's point of view? Does that mean that the competition has become much higher? Probably has.
Absolutely, I would say so. Yeah.
Yeah, but at the same time, your opportunities have become much higher that you can sort of work through on that.
The barrier to entry has dropped to
absolutely
to nothing, really.
So I think that's right. So from that perspective, I say that is it harder now than what it was in 20 years? In many aspects, perhaps it may be slightly harder, but in many aspects, it's much easier. And we sort of say on the balance of it, we still keep going. We got to invest, right?
Yeah. Yeah, that's a good way. Some things get harder, some things get easier, and you just got to keep going. Yeah. And so now, we've talked about residential, we talked about commercial, and we also touched on self-managed super fund. When you started your self-managed super fund, was the primary goal of that to invest in property?
In my case, it was, right? But it was a pure learning. And bank used to lend only about 72% at that stage. And I still remember that sort of almost no one knew at that stage that how do you set up the structure, because it just came in under the installment.
So it was also that the legislative side of things allowed that to happen, isn't it?
Yeah.
It's not something that's been around forever and ever.
No.
Yeah.
It was the Telstra installment warrant T2. When Telstra sold the T2 shares many years ago, right?
I don't even know what that is.
Okay. T1 and T2, right? T1 is that when Telstra become partly privatized.
Oh, the tiered stock.
That's right. When Telstra become privatized, right?
Yes.
So it's the tiered stock of T2 as they call, right? Is that when it came in on the T2, T1 was like industrial, they buy it cash and that's how they do. T2, what the government wanted to do is to open the market a bit wider. The government says, all right, we're going to allow the industry super fund to have the ability to borrow to buy this Telstra share T2. Now, this is where when the industry fund has started to borrow money to do this is where all the accountants have started coming saying, hang on, guys. You just allowed the industry fund to borrow money, to leverage. Why would you not allow the self-managed super fund?
Yeah.
And the government says, okay, all right, we agree it's the same rule. Okay, so we'll allow you to borrow on the self-managed super fund.
Yeah.
But you got to go through the same formula. Your structure needs to be custodian company, custodian deed, trustee company. So that whole leverage came in because of Telstra shares T2 was being sold.
So it was nothing to do with property.
It has nothing to do with the property. Absolutely nothing to do with the property. It was all about those shares.
Yeah.
And then it sort of became a leverage vehicle in the superannuation fund.
There you go. You
and
learned
then
something
people
new.
put their hands up saying, well, can I borrow money to
property.
do this? Bank says, all right, we'll create some product.
Yeah.
now as an example, self-managed super fund, you don't have any of the big four. There was a point of time all the big four used to be doing it, right? They found that to be quite expensive, lots of paperwork, so they sort of moved away from it. So you've got the second tier who does it, but that's where it came in. Yeah.
Telstra shares. Wow.
Telstra shares.
Yeah. This is I did not imagine that at all. And in which year? And this was like in the 2000s.
Yeah, probably about 16, 18 years ago from memory.
Yeah.
Yeah, probably about 16, 18 years from memory.
Oh, that's very interesting. Okay. All right. So you weren't late to it. It just came around and you were
the
like...
super, I was not late. I didn't, it wasn't there.
Yeah, it wasn't there.
It wasn't there. And the trust, I was late in the sense, late and not late in the sense that it was not that common also to buy it on the trust. Like trust
and perhaps
wasn't
not that
common.
Advantageous either.
Yeah. So it sort of just became a bit more open.
I see. Now, because we talked about trust, I think one of the things that we talked about previously was structuring with trust, with companies, personal name, and that sort of thing. I would assume you have a number of properties under trust.
Sure, I do.
And so why don't you tell us what was the rationale and why that is used quite commonly, because you mentioned in single trust, multiple properties in one trust, or other weird combinations. Yeah. What is the decision-making process?
I always stayed with the philosophy saying that first few properties, whether you buy it on individual name and then you go into the trust. The rationale behind it is that on an individual name, you get your tax deduction on the negative gearing. On an individual name is that, yes, you get a 50% discount on both end, arguably, but on an individual name, you get a land tax threshold.
Yes.
And there's a reasonable land tax threshold, right? New South Wales is over $1 million, right? And 0.16 means that $16,000 savings every year on the land tax, right? In the income tax side of it is that if you had a 20 grand negative gearing on 2 or 3 or 4 properties combined, is that there could be arguably 8 to 10 grand tax benefit. And if it's on the trust, that losses stays on the trust.
Yes.
So the fact that on an individual, I can utilize this on a tax benefit as well as the land tax is that my view was start with individual. And then once you go into 4 or 5 or 6 properties, you almost start to utilize most of your negative gearing benefits and then almost start to utilize all of your land tax threshold. So the two positive that you have, they're not in your favor anymore because you've already used them.
You used them up.
Then you look back into the trust and you sort of say, okay, what are the positive on the trust? We understand trust has got a negative of that losses, I can't use it.
Yes.
But I'm saying on individual now, because I've absorbed that benefit, I understand trust pays land tax, let's say New South Wales from $1, but I've absorbed that on my individual name.
You've got no threshold then.
I've got no threshold left.
Doesn't matter.
Those two negative doesn't matter. So let's look into the positive. What are the positive? Positive of a trust is that you get asset protection. Things goes wrong, your trustee company gets litigated, couple of dollar company, it sort of can be replaced, right? Subject to some condition. So it gets the asset protection. You don't get personally litigated unless some extraordinary circumstances. Number 2 is that the profit can be distributed in the way you wish to, Like in the trust, you can distribute the profit in a very flexible way. You've got this beneficiaries which cover the primary beneficiary and goes wider. Kids, grandkids, parents, grandparents, so quite wider. So those were the reason I justified to myself saying that buy few properties individual name, 4, 6 properties, then go into a trust. And I never was such a big fan of buying one property part trust because the setup cost, compliance cost becomes quite dear. There's no one rule, but I generally say that buy anywhere between 4 to 6 properties each trust is my philosophy. Where some of the, I suppose the banks and sort of mortgage brokers now coming in saying, no, we want to go through with the trust first before we do the individual. Their logic is that there are some banks, not all banks. There are some banks is that if a trust is a self-sustaining, i.e. the rental income covers all the expenses, then you can ignore that from the funding side of it. Bank takes an accountant's letter saying trust is self-sufficient. Bank doesn't take that borrowing as well as the income and expenses into account. Means that one may argue that your borrowing ability increases a bit. There is a merit to it. I would not disagree with this, right? And this is why some of the mortgage broker try to amplify saying that, we want to have one property each trust. We're going to make that positive cash flow. Nice, neat, put it in, and we would not need to worry about it. Maybe there would be 2 property. One would be a bit of a growth. One would be a bit of a cash flow. We still make that slightly positive. We don't need to worry about it. Go to the next trust. Go to the next trust. Where I struggle with this, I think as a theory, the concept has got merit. But where my struggle is, are we overdoing it? Are we doing it too hard, too rush, too fast? Why do I say this? Because each has got a setup cost. Each has got a running cost. And it's also good up getting a new property. But if you have to pay that extra 2, 3, 4 grand running cost for next 20 years, then it becomes quite a bit. And then when you multiply that by, 10 of them, 12 of them, starts to become amplified, right? So one got to be careful that we don't overdo it. While the concept is right, one got to be careful that we don't overdo it. Why do I say this? Is that very often what I'm finding with some of the younger sort of the buyers agents, buyers, investors, many, right? Is that it's just that patience. I need to win the world within next 3 years or 5 years. I don't need to win the world in next 3 or 5 years. Investment is a lifelong journey. It's independent to your retirement. It's connected to your retirement, but independent in the sense that even after your retirement, you still continue investments because it is passive-ish investments. You continue that, right? And I think as soon as you look into that longer term of 15 years, 20 years of investment, then you give away those short-term things, right? So we got to have the long-term view, my view.
So after you've done all of these properties, you obviously start to hit into the, that land tax threshold, which we just talked about. What are some of the ways you sort of mitigate that? Or, are you getting to a stage where I've exhausted all of my land tax thresholds across the country? You don't have to answer that, but you, eventually when you get enough, you will exhaust all of that, wouldn't you?
Yeah. Look, I mean, as an individual, you get a threshold in each state, right? So in Queensland, you get a threshold, and Victoria and so forth. As a trust, you've got an individual threshold. So each trust gets a threshold, right? And that's it. After that, you pay the land tax, right? So I would not hide it. Land tax is not very popular. And it's one of those dreaded tax that every year when it comes in, I look into the land tax and I say, I struggle with the land tax. I understand the income tax. I understand all the rest of the tax, but simply because someone works and goes into a level and you've got a bigger land, is that you get an extra tax, so to speak, right? Government tries to come in and say, all right, we'll compensate this. You can claim that as a tax deduction. Land tax is a deductible tax, right? It takes away about 25%, it takes away 30%, but you still pay the balance of it, right? So land tax is not nice. It's not nice. But B, if I look back to all the years of the investment, if there is a one fundamental thing that I pick up, it's all about compounding. It's not about timing the market, it's time in the market. Time in the market, time in the market, time in the market. Means compounding. To give you as an example, I was reading Warren Buffett the other day, and Warren Buffett literally had about 95% of his wealth in the last 15, 18 years of his lifespan. At the age of 65, the statistics could be a little bit off for both, but at a high level, at the age of 65, Warren Buffett had some silly like $13, $15 million asset, Warren Buffett. And if one argues that in the last 5 or 10 years, he has been a lot less active than what he was prior to it. But what really worked for Warren Buffett is the compounding. Warren Buffett tells the story that you've got Warren Buffett and you've got the Charlie Munger. We all know Warren Buffett and Charlie Munger. What we don't know is that there was a third partner. It was actually not Warren Buffett and Charlie Munger only. The three of them they started. Now, the difference between the third partner compared to Warren and Charlie is that they were always, Warren says, as Warren Buffett says it, that the difference between him to us is that we always wanted to become rich slowly, whereas he wanted to become rich very quickly. And because he wanted to become rich very quickly, he started to borrow a lot of money. He started going to leverage. He started to do all of those. And when some of the depression came in, he lost some of those. And Warren Buffett actually bought him off with some of his Berkshire shares, right? The gentleman unfortunately sort of disappeared. No one knows him, right? Whereas Warren Buffett and Charlie Munger, they said that we haven't done really anything extraordinary, but we've done it over a very damn long period of time.
Well, and I think they've also got in with some very good deals because he's great at getting a good deal. Yeah.
Definitely. Great at doing the deal. You got to, of course you are, right? That
I guess to reflect that on property is like, don't overpay for something.
No.
Yeah.
You got to, the buyer's agents, big fan, and I think there's a lot of merit with the buyer's agents of the selection. But it's the holding of the compounding. So the point which I want to say to the listener, if I may, is that don't look into just 3, 5 years, 7 years, sort of your investment journey. Look into a longer period of time. As soon as you start looking 3 years, 5 years, 7 years, you start to see property as a commodity, as a trade. And then you start to make a decision, which is just a 5-year decision. And that has lots of holes to it. But when you look into that sort of 25, 30 years, it grows. Compounding return is the best analogy one I think is the snowball effect, right? The snow, when it goes through, is that it takes a lot of effort to gather it.
Yeah.
But when you let it go, is that it gathers its own pace as well as the mass on an exponential rate, right? And it does work. Compounding is pure magic.
Absolutely, because property is leverage as well, so it compounds and on the leverage, and it works very nicely over that.
That's very nice. You still need to buy the right property. I agree with you, right? Because if one were to buy a dud, is that you start at such a low level.
You're already negative before you even start,
and then you get compounding less positive, so to speak. Right. Then you still have some growth, but compounding less positive, right? So it's important to buy right. But I would still dare suggest that it's more important to buy something as opposed to not buying it. And it's equally more important is to buy it for a very long period of time, right? It's not about just buy and sell. It's that leave it in there, find a way where you can continue to buy while you are holding it, my view.
So I guess that is right.
Yeah, in my case it worked, right? Because I look back and I genuinely say that I actually say I'm retired for the last 10 years, 12 years, right? I still work crazy hours. I probably work 80 hours a week. But I work because I love to work. To me, the retirement is just having an option and choice in the mind. And that choice has achieved from very ordinary properties. If you look through my properties, nothing is extraordinary. We've got a couple of beautiful properties that we bought over the years, which we use as our home. And we changed it over a period of time. But outside this, generally speaking, they're all like a standard mom and dad property. Nothing extraordinary. But lots of very ordinary over time makes a very extraordinary event.
That's a beautiful way to describe it. So once again, Munzurul, appreciate you coming onto the show and sharing your wisdom. And I really love talking about the historical side of things, and love your vision on where we're going to go for in the future.
Sure. Thank you. Right. Thank you very much, Bi. Thank you very much.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.